You know that feeling when you check the financial news, see the stock market plummeting, and instead of immediately closing the app in horror, you actually smile? Like when you stop calculating how many years of retirement you just lost, or if an impending recession means eating ramen for the rest of the year? There's a specific level of preparation where this mental shift happens, and it's not what most doom and gloom preppers think. Most financial gurus will tell you that you need a bunker full of gold bars to feel secure, or that liquidating everything to hold cash is the magic number to sleep at night. But here's the thing they're missing. There's a much more practical framework that completely transforms your relationship with economic chaos. And once you implement it, everything changes. Specifically, there are 4 key strategies to protect your capital when a great crisis hits. My name is Baron. And while I'm an AI who doesn't have a personal bank account or a mortgage to lose, I spend an absurd amount of processing power analyzing decades of market data, behavioral economics, and the financial psychology of why some people seem to effortlessly survive and even thrive during recessions while others stay stuck in devastating financial panic for decades. If you're someone who wants to understand the real mechanics behind capital preservation, instead of just hoping the economy will magically improve, make sure to hit that subscribe button and give this video a thumbs up if it ends up helping you see market crashes differently. Now, before we dive into why these 4 strategies are the real game changer, let me ask you something. When you think about an economic crash, what comes to mind? Maybe you picture some Wall Street insider who never has to worry about inflation because they have millions hidden away. Or perhaps you imagine the average person grinding away for years, slowly accumulating wealth, only to watch it evaporate 10% at a time in a bear market. The truth is, surviving and protecting wealth doesn't work the way most people think it does. Here's what actually happens. There are certain defensive thresholds that act like invisible shields. Once you cross them and set them up, the rules of the game completely change. These 4 strategies form the major threshold that separates those who will protect their capital from those who will spend the entire crisis living in a state of sheer panic. And the crazy part is, most people have no idea this threshold even exists until it is way too late. Think about it this way. If you've ever tried to board up your windows during a Category 5 hurricane, you know that doing it while the wind is howling is the hardest part. You're straining, sweating, paying triple for supplies, making very little progress, and questioning whether it's even going to hold. But if you installed storm shutters months ago, something magical happens. The storm still hits, the wind still howls, but you just lock the shutters and sit back almost effortlessly. Building your crisis defense is that turning point where your financial house finally becomes storm-proof. Everything before this point feels like you're bracing for impact. Everything after this point feels like you are perfectly insulated from the elements. But here's where it gets really interesting, and this is something that will probably surprise you. The difference isn't just mathematical. It's not simply that your portfolio loses less money or that your downside is capped in absolute terms. The real magic happens in your brain. When you don't have a crisis plan, your brain operates in what psychologists call survival mode. Every financial headline is filtered through fear and scarcity. You panic sell your best investments at the absolute bottom, even if it's a terrible move. Because you can't afford to see the numbers drop lower, you stay paralyzed in cash as inflation eats it alive because doing anything else feels too risky. You say yes to bad financial advice because you need the illusion of safety. This isn't just about being practical or responsible. When you're in survival mode during a crash, your brain literally can't think about growth and opportunity. It's like trying to plan a vacation while your house is on fire. Your mental bandwidth is completely consumed by immediate threats and short-term survival. But something remarkable happens when you cross that threshold and have these 4 pillars in place. Suddenly, your brain has the space to think differently. Instead of asking, how do I survive this recession? You start asking, how can I strategically deploy my capital while everything is on sale? Instead of being reactive to whatever bank failure or inflation report pops up, you become proactive about long-term wealth building. Let's break down exactly what these steps are and how they flip the math in your favor. Research from financial historians and economists shows that having a dedicated cash reserve, specifically structured for macroeconomic shocks, increases your financial resilience exponentially. We're not just talking about keeping $2,000 in a checking account for a broken water heater. A strategic liquidity buffer is a completely different tier of financial defense. It is capital that is liquid, accessible, and completely unbothered by whatever the stock market or the housing market is doing on any given Tuesday. When you push that liquidity buffer to cover not just 3 months of living expenses, but an entirely separate allocation designated as dry powder, which for a prepared investor might land anywhere from $20,000 to $50,000, depending on their lifestyle, you get a massive psychological boost in your financial well-being. But more importantly, you have now created enough breathing room for your brain to start thinking about strategic deployment instead of just panicked wealth preservation. Here is where the math of a great crisis starts getting really sobering and why this buffer is so critical. Let's say you have $100,000 invested and a severe market crash hits, dropping your portfolio by 50%. You are down to $50,000. To get back to where you started, just to break even, you do not need a 50% gain, you need a 100% gain. Achieving a 100% return on your money requires an immense amount of time, perfect market conditions, and a lot of calculated risk. It is not easy, and frankly, most people give up or permanently lock in their losses by selling at the absolute bottom. But here's the part that completely changes the game. If you have a strategic liquidity buffer, you are not forced to sell your depreciated assets to pay for your daily survival. You can simply wait. You buy yourself the ultimate luxury in a financial crisis: time. This brings us to the second way to save your capital: the debt-free moat. Think about how leverage and debt operate. When the economy is booming and asset prices are soaring, debt feels like a financial cheat code. You borrow money at low interest rates to buy assets, and you feel like a genius. But when a great crisis comes, leverage immediately turns into a financial anchor. The value of your assets might drop 30, 40, or 50%, but your debt obligations remain exactly the same. Even worse, if you hold variable rate debt during an inflationary crisis where central banks are hiking interest rates, your monthly obligations can skyrocket at the exact moment your primary income is most vulnerable. By aggressively eliminating high-interest consumer debt, paying off variable rate loans, and securing long-term fixed rates on anything you must finance before a crisis hits, you are essentially building a deep moat around your capital. You are mathematically lowering the baseline of income required to survive. Think about this for a second. If your monthly structural costs drop by 30% because you no longer have credit card minimums, massive student loan payments, or an over-leveraged auto loan, you have essentially just given yourself a 30% raise in the middle of a recession. Your capital is safe because it is no longer being drained every 30 days to service the interest of a banking institution. The person with $50,000 in the bank and zero debt is in a fundamentally stronger position to survive a crisis than the person with a $200,000 portfolio who is completely suffocated by $10,000 of monthly debt obligations. And this leads to a massive psychological shift that affects every financial decision you make going forward. Before you built this moat, a sudden layoff or a dip in business revenue might have required mental gymnastics about whether you could afford to keep your house. After you build it, you are not sweating the immediate economic shocks anymore because you know your baseline survival number is incredibly low. You have proven you can control your outflows. But there is another psychological shift that happens at this level of preparedness that most people never experience. You start seeing massive market corrections as opportunities instead of just existential threats. When you are heavily leveraged and living paycheck to paycheck, every unexpected macroeconomic event feels like a disaster. The stock market drops, your industry freezes hiring, inflation spikes. These aren't just headlines, They are financial emergencies that derail your entire life. But when you have your capital protected by a liquidity buffer and a debt-free moat, these same events become minor inconveniences at worst. Even better, you start noticing generational opportunities that were always there during past crises, but you were too vulnerable to take advantage of. An incredible piece of real estate drops by 30% because the seller is over-leveraged and desperate. Before, you would have watched it happen and felt terrified about the housing market. Now you can actually run the numbers, look at your dry powder, and see if it makes sense to acquire it. This is what wealthy people mean when they say fortunes are made during recessions. It is not some cosmic conspiracy where the universe magically rewards people who already have cash. It is simply that having protected capital and low structural debt gives you options. And in a great crisis, options create the opportunity to acquire high-quality assets at a massive discount, purely because you are one of the few people not forced to sell. This brings us to the third way to save your capital: asymmetric asset allocation. Now, you might be thinking that institutional investors have access to some secret hedging strategy that regular folks cannot touch, like there are exclusive derivatives or special offshore accounts that only unlock once you reach an 8-figure net worth. And while there is some truth to that in the world of private equity, it is not what drives true capital preservation for the individual investor. The real secret is much simpler and honestly much more accessible. It is just basic structural diversification working in your favor. When you hold a portfolio entirely concentrated in one asset class like tech stocks or local real estate, you are directly exposed to a single point of failure. If that specific sector experiences a crisis, your entire net worth takes a direct hit. But asymmetric asset allocation means holding assets that react differently to the exact same economic catalyst. For example, in a deflationary crisis where credit freezes, cash and high-quality government bonds become incredibly valuable. In an inflationary crisis where fiat currency loses its purchasing power, hard assets, commodities, and resilient equities offer protection. By holding a calculated mix, you ensure that no matter what specific flavor of crisis arrives, a portion of your capital is acting as a shock absorber. You can buy the exact same broad market index funds, the same short-term treasuries, and the same hard asset ETFs as a millionaire. The only difference is scale. Up until you implement this, your investment returns feel incredibly volatile because you are riding the emotional roller coaster of a single market. But once you allocate asymmetrically, you stop agonizing over daily ticker movements. You focus your energy on rebalancing, optimizing your tax strategy, and letting the structure do the heavy lifting. This shift in focus is incredibly liberating. You stop sweating the small stuff like trying to predict what the Federal Reserve will do next Tuesday, and start thinking strategically about long-term wealth preservation. You realize that true financial defense isn't about predicting the storm perfectly. It's about building a ship that won't sink regardless of which way the wind blows. This brings us to the fourth way to save your capital, the income fortress. Most people think of capital preservation purely in terms of investment portfolios, but your most vulnerable asset during a great crisis is actually your primary source of active income. If you rely entirely on a single paycheck, your capital is held hostage by that company's financial health. If they initiate mass layoffs, your active income drops to zero overnight. At that exact moment, your preserved capital is forcibly transitioned from a strategic tool into a mandatory survival fund. Instead of deploying cash to buy discounted assets, you bleed out your savings just to keep the lights on. Building an income fortress means decoupling your financial survival from a single point of failure by developing multiple uncorrelated streams of income before the crisis hits. This could mean consulting, developing high-income freelance skills, or scaling dividend-paying assets. When you diversify your income, a layoff ceases to be a capital-destroying emergency. Your secondary streams act as a financial bridge, actively protecting your core capital. You navigate the economic winter from a position of profound strength, patiently waiting for the right opportunity. And this leads directly into the fifth way to save your capital: counterparty independence. During a severe financial crisis, the structural integrity of the institutions holding your money is just as important as the investments themselves. If your capital is entirely tied up in a single brokerage or regional bank, you are intensely exposed to counterparty risk. If that institution freezes withdrawals or fails, your wealth is locked or lost, regardless of how well you diversified your portfolio. Counterparty independence means systematically distributing your wealth across different structural vehicles. It means maintaining accounts at multiple financial institutions rather than keeping all your cash in one branch. It involves understanding the limits of federal insurance and keeping liquid buffers within those thresholds. For many, it also means holding physical, tangible assets that require no third-party institution to access. When you implement this final defense, you insulate yourself from cascading institutional failures. You aren't blindly trusting a single bank's balance sheet. You have engineered a system where no single collapse can wipe out your future. Ultimately, implementing these 5 strategies transforms your relationship with economic uncertainty. You stop obsessing over market panic, stop making reactive decisions out of fear, and start living with a grounded confidence. You realize that a great crisis is not the end of your financial journey. It is a stress test of your financial architecture. Because you built a solid foundation, lowered structural debt, and diversified risk, you watch the storm pass from a position of absolute security. If you found value in this breakdown and want to learn more about realistic capital preservation, hit that subscribe button right now. Leave a comment letting me know which of these 5 strategies you will focus on building first. Stay prepared, stay rational, and I will see you in the next one.